Hello, everybody. Can you hear me all right? Welcome to our stream. As we usually begin, where are you guys coming in from? Where are you watching from? The Ready Set Crypto community is all over the world, so we're really excited to bring you this education and make it worldwide to our stream. All right, cool. Looks like it's doing well. Awesome. The UK, Spain, Kuwait. Hello. Boston, Florida. Wow. Yeah, we got everybody all over the place today. This is good. Indiana, Canada, eh? Cali, eh? Montreal, Chicago, Switzerland, the Netherlands. This is excellent. Guys, we have a really awesome program for you today. And before I turn it over to Checkmate, who's going to be leading this off, just want to give you a quick little brief on who he is and what he's bringing to you today. Checkmate is this really smart guy. I'm just have the absolute pleasure of working with him. He does a really good job of breaking some really complex topics down into really easy to understand ways. And what we're trying to bring to you today is something that we feel is just absolutely critical to understand in this day and age as Bitcoin becomes more prevalent in the market, as we move into this new era of the cryptocurrency space. Understanding what Bitcoin is doing by using on-chain analysis is just, it's going to put you on another level. So Checkmate is going to kick this off in a little bit. But before we get started, I just want to make sure that you guys know that we represent Ready Set Crypto. And part of that is our community. And if you guys are interested in understanding or joining our fundamental analysis and Checkmate's research topics, you should seriously consider joining our community, because this is the type of content that we produce every day. And we want to share with you the sort of analysis and updates that go beyond just the normal news. And Checkmate Doc and I are just absolutely obsessed about providing just the best content out there, the best education, providing you the investor education portal of the new digital economy. So we're really excited to get this started. I'm going to turn it over to Checkmate. Take it away, man.
Thanks, Mav, and good to be here. If everyone can just let me know, make sure my mic's coming through all right, and we'll kick this thing off. So as Mav was saying, this is I'm excited to bring you guys this. It's I think on-chain analysis for Bitcoin specifically, and really Bitcoin's the main network that we can see a real heartbeat going on in the network, and it really is a tool of the smart money. And if you can start to wrap your head around what these signals mean, and granted, a lot of these things are going to change, a lot of these network behaviors are going to move as the Bitcoin network grows, but understanding the fundamental metrics about what you can actually derive from the ledger is it's going to be hugely valuable. And believe me, the smart money is going to be looking at this thing, and it's great to get your head around what it all means. So today we're going to be going through the network value transfer ratio, the NVT ratio, and there's a few different variations of this. So I'll talk through all the different models and even a little bit of my own analysis, which you probably won't have seen anywhere else. So hopefully you can draw a lot of value from this thing. And let me kick it off. So first up, I love to give credit to Will and Dimitri, who really wrote the baseline for what the NVT was. There's been a number of people who've contributed to it, but really Willie and Dimitri have done the most, I guess, refinement of this concept. And Willie's got quite a number of papers, so again, a huge credit to them. And again, it's an open source industry, so it's great to have all this information and knowledge sharing, which is what we're all about. So I'll start off with what on-chain analytics actually are. And really, Bitcoin introduced a radical paradigm shift, and that is an uncensorable transparency. Effectively, everything that occurs on the Bitcoin ledger is sealed in history by the most secure encryption system that really the world has ever seen. And that really makes it's almost a new level of permanence. So once something gets onto that ledger, it's effectively there for eternity until a Bitcoin gets taken down, which is at this point in time a far-fetched concept. So if we start studying and actually understanding what's going on the Bitcoin ledger, on the on-chain behavior, we can start to understand what this digital organism, and I do consider it to be somewhat of a digital organism, is telling us about the center of gravity for the network. So that's really what we're going to explore today, and why on-chain analysis, specifically for Bitcoin, is so important. So, quick introduction disclaimer. So this is the third module in the series of this on-chain Bitcoin masterclass. And the first one was looking at the realized cap. The second one looked at modeling value with scarcity, based off a lot of the work that Plan B has done. And this module will be looking at the NVT and the RVT ratio in many of its different forms. And just a quick note, nothing in this is financial advice or investment advice. I'm just a dude on the internet. And whilst I do my best to bring you, what I see and my best ideas, it really is about doing your own research, making sure you understand what these metrics mean, and hopefully I can give you a bit of a foundation so that you can make your own decisions based on a increasingly and a growing tool set that you can start using. And really, if you start focusing on your own fundamental understanding of these things, it'll be the best decision that you make. So in terms of what we're going to cover today, we're going to look at what Bitcoin really is, which is effectively a protocol for transferring value and how it's actually performing in that regard. We're going to look at the network value transfer ratio, or the NVT. We're going to extend that to what I like to use as the realized value ratio, the RVT. We're going to look at some of the signals and the different market fractals that we can determine from this, and starting to spot what the market tops, what market bottoms, what kind of macro cycle is the Bitcoin market in. We can start looking at how we can estimate a fair valuation for the network. And we can look at some of the limitations and challenges and really where I can see this metric going and moving forward from here. So at its core, Bitcoin is a network or a protocol for transferring value. That's really what this system has been optimized for. And at its core, it's a distributed means of doing that between peers. So without that middleman side of things. And the utilization of Bitcoin as a transfer and savings mechanism, which is really a large part of the narrative, is looking at that fixed supply and using it as a savings mechanism. All of this has an on-chain signature as coins are moved between different people, whether it be exchanges, whether it be peer-to-peer, whether it be transferring between just different people. All of that gets written to the ledger, everything that's going on the base chain. And there's been a great analogy of the Bitcoin base protocol being compared to container ships of gold, rather than an everyday payment method. And really, it is optimized for transferring massive amounts of value, not necessarily volume. And this is what we see with the 7 transactions per second. But in reality, the amount of value that's contained within each of those 7 TX per second is really, we have never seen anything quite like this. And it is akin to container ships of gold in this regard. And just to give you a snapshot as to how that's actually performing, what we have here is effectively all these horizontal lines are, as of last year, to my best estimate, the amount of money in US dollars, so the total value that was transferred annually in networks like Swift, Visa, MasterCard, Gold, Silver. And then in the orange is how much was transferred if you assign a price to each Bitcoin transaction on the on-chain ledger. And then the blue line is how much was actually transferred in exchange volume. And what you can see is that, yes, Bitcoin has 7 transactions per second, but what we're seeing is it's actually starting to take up. I mean, it's already well above gold, which is the traditional store of value. It's well above global remittances. And as you can see, the thing is very, very close to taking out MasterCard. Exchange volume is almost taking out Visa. And this is a log chart. So the next stop is Swift, and who knows what goes on beyond that. So yes, people talk about the slowness of Bitcoin, but when you look at the finality and the amount of value that this thing actually settles, it's something quite remarkable considering how early this technology is in its history. And really, this is a result of the immense security that Bitcoin brings that we just we've never seen anything quite like this in terms of security. So since we can monitor the on-chain actual transaction volume of the Bitcoin network, we can actually look at the volume of BTC that's being transferred over the network. And remembering that the amount of Bitcoin being transferred isn't on-chain, it isn't inherent to Bitcoin. Bitcoin knows about that. What it doesn't know about is what time of the day it is and what the value of the USD is. And we as people assign that to the Bitcoin ledger. So Bitcoin knows what block height it is and how much Bitcoin was transferred and who owns what. That's all it knows. We then assign on a estimate a calendar time to that on-chain block height and the amount of USD based on the current price. So that's something that we assign to the system. And that does rely on an outside data feed. Yeah. So what's fairly reasonable to assume here is that if you have a high demand for on-chain transactions and there's large amounts of value moving through the network, in theory, there should be a corresponding increase in value. More utilization should lead to more valuation in the system. So when we look at something like a low network demand, we would expect that there's a low utilization factor for transfers. We're seeing a reducing number of users actually using the network, and often it's a dominance in off-chain transactions. And what you would expect in terms of price is a decreasing or a bearish type scenario. If you see a very high network demand, you're seeing lots of people using it, lots of value flowing through it. There's demand for block space, and really that's what this is all about. What is the demand for block space? You would see an increasing price. A higher network, there's more demand for using transactions, there's more demand for BTC. You would expect there to be an increase in transactions and therefore an increase in network value. So that's the fundamental premise as to what we're going to be looking at today. So what we can see here in orange is the market cap of Bitcoin, and in yellow is that same plot we had before, which is the on-chain value. And you can see that the actual patterns are extremely similar. The correlation is fairly apparent that the more transaction volume that's flowing on-chain, the higher that we're seeing the market cap and the valuation go. Now, again, there's going to be lots of nuances to this, which we can discuss later on, but you can see that the correlation is there, at least from a visual perspective. And I think the other thing to note there is that there's a slight difference. So you can see during bear markets, there's a fairly large spread between these metrics. You can see that the gap starts to close up as you move into a bear market where you get slightly smaller, more compressed, higher correlation. And we'll come back to what this actually means in later on. So for the NVT ratio, it's analogous to the PE ratio of stocks. So when you look at traditional stocks, you're looking at the PE ratio. It's effectively the price per share over the earnings per share, which you can work out as the market cap over the total company earnings. If you have a very high PE ratio, it means that either the numerator is too high or your price is overvalued relative to the amount of value that's flowing through that company, or the earnings are low and decreasing. So in this instance, it's slightly counterintuitive, but a high PE ratio generally means an overvalued or potentially a sell signal, whereas a low PE ratio or a decreasing PE ratio indicates that you've got a low price or it's undervalued, or you're getting in the denominator, you're getting a higher earnings per share, and there's a bit of acceleration there, and perhaps it actually is an undervalued stock at that point in time relative to the amount of value that's flowing through the company. So we can almost directly translate that across to Bitcoin for the NVT ratio. We're effectively looking at the price per coin divided by the transaction value per coin, or an easier calculation is the market cap divided by the total transaction value, all denominated in US dollars. So similarly, if you've got a high NVT or RVT ratio, it's potential that there's not enough utility and transaction flow through the network, and therefore you have a overvalued state. Somewhat you can start spotting things like market tops. And likewise, once it transitions into a decreasing or a downtrend in the NVT-RVT ratio, it potentially indicates you've got an undervalued state where your transaction volume is actually increasing, but your price may not be keeping up, or conversely, that your price has descended so low that it's actually undervalued relative to the amount of value that's being put through the network. So in terms of some fractals here, this is the actual plot out of the transfer value in USD over the entirety of Bitcoin's history. And just to note, all my data here is taken from Coinmetrics. So if you want to plot these up, you can access most of these charts and data sets from Coinmetrics himself. And you can see here, similar to what we had before, where you've got a fairly large band where during bearish markets, you get a divergence between these two. And then during bull markets, you tend to have a smaller spread between your transaction volume and your actual market cap and price. So you can see, and because you can see there's quite a bit of scatter in the data, obviously daily transactions and things fluctuate quite a bit, it's fairly commonplace for us to go and apply a smoothing factor, which we'll talk about in a second, and which types of smoothing factors are rational to use and reasonable to use, because otherwise your signal becomes way too noisy. So in terms of smoothing out the transaction flow, there's a number of approaches we can take, and really it depends on the problem that you're trying to solve. And it does take a bit of judgment, but really you can hone in and look at, for example, the NVT 28 average. You're effectively doing your NVT ratio of market cap divided by transaction volume, and then you take a 28-day average of the total sum. Now, what this is good for is kind of zooming in a little bit if you're looking at things on the daily basis and you want to kind of see what the market's doing as of today, more of a micro view. But because you're smoothing both the market cap and the transaction volume, 28 days, you actually distort a lot of the... it's still noisy, but you're taking out a lot of that high frequency signal. And because you're smoothing the average of both the market cap and the transaction volume, this is best used as kind of a trend indicator rather than a trading indicator. You're better to use this for looking in detail, but looking at it more from a trend-based thing. So you're looking for fractal patterns. Is it in an uptrend? Is it in a downtrend? Is it flat and horizontal? That's the kind of scale that you're looking at here. If you start looking at a very long term, so if you're looking across the entirety of Bitcoin's history and you're trying to understand what's going on in that level of fractal, or a very macro view, something like a 90-day smoothing average is probably reasonable. It will take out a lot of the noise. You'll get a lot smoother curves, and really you're looking for significant breaks and levels that this thing touches. And again, the more that you smooth these things, the more averages that you put on there, the less noisy they become, but the slower the actual signals will be, because you're taking that long-term average. One thing to note though is that the higher that you smooth it, so a 90-day, once it actually gives you a signal, yes, it's normally later than what you would like for an optimum entry, but it's a much higher conviction signal. Whereas if you're using a 28-day moving average, you're going to get a lot more noise, and you do have to filter it out, and there'll be a lot more false signals. So it's that higher conviction from the greater moving averages. And the last one, which Dimitri really built up, was the NVT signal, the NVTS. And what this does is it smooths only the transaction volume. So what this allows it to do is, because you're smoothing transaction flow, but you're keeping market cap, which is subject to price, a lot more volatile, it tends to conform a lot more to trading indicators, so you can do more technical analysis. And if you're getting any significant moves in the NVTS, it either means you're getting a very, very large change in price, say a shot across the bow at the start of a bear market. If you're getting a very, very significant change in price, or there is an extremely significant change in transaction volume, such as some very, very large coins selling towards the end of a bull market, that has to actually override the 28-day moving average. So it gives you a very, very high conviction signal when it moves a very significant by a significant margin. And because it does conform to more technical analysis signals, it's much better if you're looking at it from a trading perspective. So that's really where the NVTS shines, is in that real micro scale of large events occurring. So we'll just run through quickly, and you can kind of see the shape of these. So this is the 28-day moving average plotted over the entirety of Bitcoin's history. You can see it's fairly noisy, but at the same time you can see fairly distinct trends in this thing. So it is a relatively fast, and it's good for trend type trading and looking for value points. The NVT 90, you can see that it does trail the NVT 28, so it's a much slower but higher conviction signal, and you do filter out a lot of this noise. And again, very, very good for long-term trends. And we'll run through each of these in a real live scenario to see how you could actually use it to identify fractals. And the NVTS, you can see a lot more noisy, but you can start to see levels of support. You can start to see where it moves. You can actually see the transition into downtrends and uptrends. So it gives you a lot more understanding of what's actually going on under the hood. So you can start to use some of these technical analysis. You can look for these reversals and what they actually mean when one of these events occurs. So you can use a lot more support and resistance, seeing when it breaks down below these levels, and using that for more discrete, okay, this is a point of interest. So The RVT ratio is an interesting concept. So the NVT is noisy because of two regards. You've got a lot of noise coming from the price because price moves on a minute by minute basis. And you've also got transaction volume, so we have to apply some degree of smoothing to this. Now, what's interesting is you can use the realize cap. So for those who are not familiar, the realize cap is effectively every single transaction of BTC, you assign a value to when it last moved. So if somebody bought a coin for $2 and hasn't moved it ever since, all of those coins will be still priced at $2. Now, when they go to move that coin, it will be revalued at whatever the price is as of today, as of the point of when it moves. So it's a lot more of the value stored in Bitcoin. How much did somebody pay and then save in Bitcoin is a much better value of what the realized cap or the realized price is trying to study. So the realized price is a much, much smoother curve. It naturally is a smooth curve, and you can start to see a bit more of a step function in the way that it behaves. And we covered a lot of this in the first module, but because that numerator is now relatively smooth, you can start to look at what the transaction value moving through the network is relative to how much money has been saved in Bitcoin. So it's an interesting metric, and it's a lot slower than the NVT. However, the signals that it gives are extremely consistent based on the market data that we have, and it gives you a much, much higher conviction for when things come. And what you can really do is start to use these two metrics in tandem to look for high conviction signals as to when your tops and bottoms may be starting to come about. So in terms of its fundamental difference, we'll talk about what the NVT and the RVT look like. So for the NVT, as we said, there's the market cap over the transaction value. What this is fundamentally doing is looking at the amount of utility or the amount that people are actually using Bitcoin versus the market value or the spot value. It's relatively noisy, it's a fast signal, and technical analysis concepts can apply. If you're looking at the RVT ratio, this is the realized cap or the saved value, stored value in Bitcoin, and you're comparing that stored value to the amount of utility. So it's a relatively smooth and slow signal, but it gives a very, very high conviction macro trend type fractal. So in this sense, it's extremely useful for spotting, particularly when a sustained bull market is in play, and particularly when we may be transitioning into a bear market, and particularly the point of accumulation. So it's a very, very high conviction signal for when you get a macro shift in the market's behavior. So this is just an example here. So we've got the market cap and the NVT in orange, and the realized cap and the RVT in blue. And you can see here, so this is the 2018 bear market, or the start of. And these are just some key levels which we'll talk about later on. But in particular, 10 is a fairly important level based on what we've seen to date. And at the point when the NVT breaks cleanly above that level of 10, if you were to get out at this point here, it's probably not a bad exit considering the market that we've just come out the other side of. Now, the RVT, when it breaks above 10, obviously a lagging indicator, but really it's that high conviction, yes, we are now in a bear market scenario. Even up at this point here, there's a lot of people who still didn't quite recognize that this was a bear market, but here you've effectively had your initial signal, you've had your confirmation, and now you can start to adjust your strategy accordingly. So one of the very valuable fractals that I've noted, particularly for the RVT ratio, is that level of 10. When you're getting a sustained flat NVT or RVT ratio, it effectively means that your price is increasing, but so is your demand for block space, because your numerator and your denominator are effectively increasing at the same order of magnitude. So when you have a sustained run that's horizontal, effectively sideways movement in the NVT and RVT, it does indicate a strong bull market or a sustainable bull market is in play. You've got rising demand for block space, rising price, more hodlers, more traders, more demand, the thing should go up. That network value has shown to go up over time. You can see this break above 10, and once this thing actually moves, and you can use the NVT here to say, well, it's now moving into an uptrend. And as we said before, once you move into an uptrend and you've got increasing ratio, it indicates that your price is overvalued, and there's the demand for block space is starting to filter out of the network. So you're getting that reduction in the numerator, but you're also getting a more significant reduction in the in the demand for block space in the denominator. So there's falling off demand. A lot of this is governed by off-chain exchange volume. So a lot of this volume gets taken off the chain because there's more going on exchanges with traders, and you're getting a declining price. So it moves into that uptrend, and you get that reduction in value through the bear market. And then as we transition into the downtrend and this ratio starts to turn around, you can see that we actually were in that period of maximum opportunity of accumulation. In the RVT class, we talked about how important this break below the RVT ratio is. Sorry, the realized cap. And when price is actually trading under here, the entire market on a cost basis is now underwater. So this is a very, very high conviction signal. You get your NVT and your RVT transition into a downtrend. You've got price below the realized price, and you're therefore in a position of, yes, this is a high conviction accumulation phase. And this is really indicative of a low price, and the denominator or the transaction volume is now increasing to a very large extent. And that's when the smart money are stepping in. The smart money are buying this thing at a significant discount, whilst all of the retail traders are basically dumping their bags, and you're getting a very, very large amount of Bitcoin moving off exchanges, being withdrawn, taken out of the mix by fairly large deep pockets. So that's really what this transaction flow transition to a downtrend is indicating. And again, two high conviction signals that you can use in tandem. And just to take it back here, because I'm looking at a single market fractal here, so we're looking at bull transitioning into bear and then potentially transitioning out again, I was using the NVT RVT 28 here. So taking a 28-day smoothing average because I'm looking at kind of a, maybe a 2-year period of time. So if we distill that down into what those signals really mean, with both the RVT and the NVT, when you've got a sustained sideways market and the RVT tends to sit below that level of 10, the market cycle is a sustained bull market. There's enough transaction flow to actually support continued price appreciation. Once you get that clean break of the NVT upwards and move into an uptrend, it may indicate that a bear market has kicked off. And again, NVT is a noisier signal, so you may get false signals. But once you start comparing a lot of these metrics, you can start to spot that there's a potential reduction in the amount of transaction flow. And there's potential that relative to the amount that the network's being used, the network may be overvalued in terms of its current price, potentially signaling that transition to a bear market. And once you then have a downtrend initiate in your NVT, RVT, indicates an accumulation phase or a disbelief rally. And it really is that smart money accumulation. Price is much lower compared to network utility. Increasing orders and larger flows of BTC are being moved over the network. And really it indicates a period of undervaluation and really the point of maximum opportunity. So we can start to look at some of the key signals that we can determine from these two. And really the NVT is very good at spotting changes in market trend at a fairly small scale level. It's good for spotting the early bear market when you get that technical analysis reversal to an uptrend. And it's good at spotting accumulation when effectively it reverses back to a downtrend. So you're starting to get that decrease in the NVT ratio. What it's not very good for is high conviction signals. Because it is noisy, both because of market cap and transaction flow, you're going to get a lot of noisy and volatile signal. There'll be false starts here and there. And it is subject to price and volume spikes. Now the RVT ratio is very, very good at spotting the start of bull markets. Because you're talking about the stored value, and very, very large transactions tend to move the RVT ratio a lot more than lots and lots of small transactions. When you get an RVT that breaks below 10, it indicates the start of a sustainable bull market where the demand for block space is significant and therefore able to sustain continued price appreciation. And once it breaks back above 10, it's a much higher conviction signal that a bear market is in effect, but it's most likely that you're already well and truly in it. And it could be potentially waiting for the next significant lower high to be exiting a position. So it's not good for spotting the early bear market. So you get that high conviction, but a much slower signal. And this is why I like to use these two in tandem, because they really do play off each other's strengths and fill in the gaps. So we'll run through some live examples here and look at how you can use the different smoothing averages here. So the NVT and the RVT here are both the 90-day smooth because we're looking at the entirety of Bitcoin's transaction history. We've got our NVT and our market cap in blue. We've got our RVT and our realized cap in orange. And then just shown there in green is the transfer value, 90-day smoothing average. So really the ratios at the bottom there are the respective line divided by that green line. So what we can see here in terms of a start of a bull market, and this has happened so far twice, although we've got some interesting fractals going on in the current market. But at the start of both bull markets, we've seen both the NVT and the RVT 90 slice down below this level of 10 simultaneously, remain there, particularly the RVT ratio, has effectively remained underneath 10, sustaining that bull market for the entirety of its run. And then when you get that first NVT break above 10, this is potentially signaling that demand for block space is starting to decrease. And you get it again here where you get the NVT break above 10, you're getting that reduction in demand for block space moves into an uptrend, and you start to see a potential for a bear market to kick in. And you can see here that this would have been a false start, although you're not far from the actual top of this particular market. So you get that initial signal here. You then get a follow-up signal from the RVT, which is much slower, but a higher conviction signal that then breaks above 10. And in both of these instances, it confirms a bear market is in effect. Now we can then watch, so during the bear market, we're getting a continued reduction in demand for block space. We're getting price depreciation. And at some point, we enter the period of opportunity where you start to move into the accumulation phase. We get a transition of both of these ratios into a downtrend, which is starting to indicate both that price is undervalued relative to the amount of transaction volume, and that transaction volume is actually starting to increase because we tend to see flat horizontal price action through here. So therefore, the denominator is actually controlling this equation. And when you move into that downtrend, it does indicate a period of maximum opportunity. And again, you combine that with the realized price where you're seeing the entire market is actually underwater, and you start to get a high conviction signal as to a period of maximum opportunity. Now, what's quite interesting over here in the current market is that we're actually seeing somewhat of a divergence between these two ratios, and we haven't seen this completely play out yet. We can see the RVT is moving to close below 10. It'll be very interesting. Again, the more data that we have from these things, the more that we can refine these techniques. But there's a good chance that we are moving into a fairly strong bull market, and it's going to be very interesting to see how these two fractals move and whether we get a sustained run of the RVT under 10, because that would be a fairly high conviction signal. So you can see here, once you've got your sustained flat in your RVT 90, you're in a sustained bull market. When you get that initial break of the NVT and the follow-up from the RVT, you're moving into a bearish market. And then during the downtrend or the transition to a downtrend, you're within that point of maximum opportunity for accumulation. So we'll run through an example now of the NVTS and the RVTS, which are more training signals. So they give you a fast signal. It's very responsive at spotting market tops and capitulation events, which are your sell signals. And the reason for this is because we have no smoothing applied to the market cap or the price. So effectively, it's very sensitive to price. And because we've smoothed out the transaction volume, and if I just jump back one level, you can see here, and granted this is the 90-day, but you can see that once you actually apply a decent smoothing curve to your transaction flow, you end up with a fairly smooth curve. At least it's smooth by comparison to your price, which is moving all over the place all the time. So because your NVTS and RVTS are sensitive to the market cap and the price, you can start to spot things like tops, which is where you get a massive price decline at market tops, or what we like to call the shot across the bow. It's that initial massive sell-off that catches everybody off guard. It effectively leads to a very, very large increase in the NVTS ratio. You can also spot market bottoms, where you get a massive movement of coins before a capitulation, where your transaction volume suddenly spikes. It's very uncommon to see a very, very large movement of coins in a bull market. It's normally fairly sustained. And so this effectively leads to a rapid decline in the NVTS ratio. So for this, the NVTS again is a lot more noisy, but better as a trading signal than the RVTS, as the RVTS will have that intrinsic smoothing from the realized price. So we'll run through the 2012-2015 market. just as a bit of context. So we've got our NVTS, RVTS, market cap and NVT are in blue, realized price and RVTS in orange. And you can see here so we'll predominantly focus on the NVTS here. When you get a significant spike, that significant drop down through this support level, it tends to correlate with a market top. And what we were saying before is that when you're getting a massive price decline at market tops, which effectively exceeds your transaction flow, these large spikes, significant moves, tend to indicate market tops. It's almost a shock to the system as price suddenly slices through that level, whereas your transaction flow will remain fairly static. And then we get this reversal. So if you actually look at this from a price directive, you've effectively got an uptrend in play, and then you're getting this reversal, this point right here, where you're getting that reversal, that slice down below this key support level, which indicates just before a massive capitulation event, and you get that reversal into a downtrend and moving into that period of maximum opportunity for accumulation. And then you get your NVTS and RVTS, again, working in tandem, that actually drop down below that key level of 10, and you start to move into the realm of a sustained bull market where you can where the amount of transaction flow is starting to support the network. So it's really looking for these significant drops in these ratios. You're really looking for a break of key support levels, because it indicates that there's a massive move, either a massive movement of coins, which is suddenly spiking up that ratio, or you're having a massive price decline where the thing is effectively falling through the floor. If we move into the most recent bear market, 2017 to 2019 market, we get a very similar effect. So you've got a sustained bull market as the RVT remains below that key level of 10. You then transition into an uptrend, and if you look at this, the start of the original market, it was effectively a bull flag up until you got this first massive sell-off that really triggered a significant move. And that's where you get this key break above level of 10, and you can actually see, based on a trading basis, when this price indicator actually transitions into a confirmed uptrend. Likewise here, just before a massive sell-off or a period of steep decline, you're getting that break of key support, and you can move into that downtrend period where you've got that initial sell signal to get out before one of these big moves. And then you get that again, that reversal into a downtrend, which starts to indicate you're in that period of maximum opportunity where you're down below that realized price. You get a transition into a downtrend, and what we're seeing at the moment is the RVTS is actually now broken below that key level of 10. And I can think we'd all say back here it's about $8,000. It still would have been a fairly clean entry point at this point in the market. So the question is, are we now in a bull market? I would suggest that at least on the fastest signal that we have, which is the RVTS, if the NVTS, we'll talk about why the NVTS may not have quite reached that level yet, certainly in that downtrend. But this is really your first, using this particular metric, your first indication that yes, we are now moving into a sustainable bull market type condition. So if we boil down what these two signals really mean, the NVTS and the RVTS metrics are a lot more responsive to changes in the market price and the mass movement of coins. And really, we're talking about a movement of coins that's sufficient enough that the 28-day moving average of these transactions is actually affected. Now, in theory, you could actually change that from a 28 to a 7-day or whatever particular metric you're looking at. Whatever the sensitivity of the movement of coins that you're actually interested in is, you're just going to be dealing with, as you go smaller to a 7-day, for example, you're going to be dealing with a lot more noise coming from the transaction space. So it depends how sensitive you want to tune that thing. I've found that 28-day tends to work quite well in this regard. That said, I'm more of a macro view investor than a finely tuned trader. So in general, it really indicates selling pressure or a large movement of coins, which you really don't see a great deal in bull markets. You tend to see large coin movements during the accumulation phase and during or just before significant capitulation or selling events. So if you look at the NVT and the RVT, once it breaks a key level of support with high level conviction, It really does indicate a sell signal. You're getting that mass movement of coins, whether it be at market tops like a euphoria or at the end of a bear market signaling capitulation. When you get that reversal into a downtrend, it starts to move into the accumulation phase. You've got an undervaluation of price. You've got increasing demand for block space and transactions. And particularly with the RVTS, once you get that initial break below 10, the fractals to date have really shown a significant buy signal. It shows that there's significant undervaluation and a sustainable demand for transaction space relative to the amount that's being stored or the amount of wealth that's accumulating in Bitcoin. So as a kind of final stage here, we'll look at how you can actually estimate that fair market valuation. There's lots of ways you can do this, but for me personally, we've seen that particularly the RVT below 10 tends to represent a sustainable demand for transactions and block space, and sufficient enough to actually deal with a bull market or to sustain the amount of price appreciation that we see. So we can kind of estimate a fair value of what the network is worth for a given on-chain transaction volume to basically to sustain a bull market. So we can take the transaction volume, which is an on-chain metric, and Bitcoin is always feeding this information through. And again, Coinmetrics is an excellent source for actually studying this. And if you take that transaction volume in USD, multiply it by 10, it gives you an idea of what a sustainable bull market valuation looks like. So it makes sense here because if your transaction volume starts to increase, we've seen that the ratio of 10 has given us a fairly sustainable signal. As transaction volume increases, demand for block space increases, reasonably the network value should increase. So that's really the fundamental basis behind this. And just to plot this out, if we look at a fair value for this, you can see there's actually a fairly good correlation. And you can really see that during bear markets is where we get this separation between the two. You get a lot more gaps opening up through these bearish periods. And then once you move into a bull market or a sustainable bull market, that factor of 10 actually manages to hold fairly well. And again, it's another sign that we are potentially moving into that bull market condition because we're starting to see those two, both the price and the transaction fair value, starting to get into sync. So some of the limitations and challenges. So this ratio in particular, the fractals I expect to change over time. They are reliant on-chain transaction flow for signal and demand. And there is a potential to extend this to exchange-based volumes and start looking at it from that perspective. But really, as more volume moves off-chain, things like Lightning Network, Liquid, more exchanges, custodians, crypto banks, and really the use case of Bitcoin I expect to change significantly over time. Holding onto your keys is not really for everybody. So we're going to see crypto banks and custodians play a fairly significant role, and all of their transactions will be effectively off-chain. So as Bitcoin evolves and we start to see use cases open up and change, the fractals that we see here will start to evolve. And as with a lot of these metrics, and this is why I like to use the RVT ratio, because it itself is closer to an on-chain metric because we're looking at the price at which coins last moved on the chain rather than the externally applied spot price. I believe that the RVT ratio versus on-chain transaction flow is most likely to have a longer lifespan than the NVT. Although I don't think that these ratios are just going to go completely worthless because the fractals will just change. And there'll be an evolution in these things. And the reality is, if you understand what these ratios are telling you, and it's effectively a ratio of demand for on-chain high security settlement on the network versus the current pricing valuation, you can still apply many of these concepts to understanding how it can extend based on the ratios and the fractals that we're seeing. So I expect the fractals to change and evolve. For now, they're remaining fairly consistent. And again, as more data and more market cycles play out, we're going to get an increasing resolution as to what this all looks like over time. So what they're really great for here is they're relying on macro shifts of coins. We're looking for large-scale changes. And really, these tools, the on-chain analysis in particular, is exceptionally good for long-term investors. If you're looking at when to enter and when to get out to try and capture the bulk of the move, on-chain signals are really where it's at. This is where you're going to get the highest signal, rather than looking at too many candles and sending yourself mad trying to work out which direction it's all going. Once you start looking at on-chain metrics, you get a much better, higher resolution view of the macro behavior of the market and when you're getting that significant shift. So I still expect significant fractals to play out. We're going to see new relationships as the use cases of Bitcoin consolidate. And eventually, this network will approach a steady state behavior. Let's just forecast that if we end up in a position where it's only very, very large shipment of gold type transactions that get settled on the base layer and a large portion operate on Lightning or some other level 2 network, we're going to see some kind of steady state that we can still use the on-chain behavior to understand what's going on a larger scale. And during the early speculative phase, where there is a lot of demand for on-chain block space, we're going to see these things continue to play out. So I still think we have a number of cycles left where these will retain relevance. And there's a potential to extend, as I said, to exchange volume. This is a fairly high-level view. The challenge here is that you have to deal with reliable and sound data, of which in the crypto space is somewhat few and far in between. And it does require some degree of interpretation between what is trading volume and it in itself is a fairly dynamic measure. So there's a potential to look at this, and it's something I'm certainly exploring in the background. And this kind of gives you a snapshot here. Again, we've just got spot price, realized price. The bottom here is, in yellow is the on-chain transaction flow. In the green is exchange-based volume. And you can see here during 2017, during that growth of exchanges and really, that initial speculation phase of the market, really the biggest peak that brought the most people in, exchange volume really did trail the on-chain volume. The on-chain volume was really driving price at this point. During the 2018 bear market, we actually saw a sync up. So there was as much transaction flowing through exchanges and off-chain volume as there was going through the on-chain ledger. And what we've seen in basically since the capitulation event back in December is a divergence between these two metrics where the exchange volume is now taking over the on-chain volume. And this really does show that significant shift towards exchange-driven transaction flows. A lot of this will have to do with leverage trading as well. So there's a lot of signal going on in here. But you can see that divergence, which actually was the reverse back in 2017. So keeping an eye on these two lines will also give you a bit of a view as to what might be going on in terms of transaction flows. So to summarize and kind of close this all out before we go to answering some questions, Bitcoin is fundamentally a transparent network for transferring value. We can study this thing in almost real time, but pretty close to real time. We're really looking at the demand for block space. What is the amount that people are willing to pay, and how much demand is there to move value between addresses, and how can we relate that to the current market valuations? So using NVT and RVT, we can start to determine when macro shifts in market sentiments and significant sell pressure can be expected, or when we start to transition into a sustainable bull market. And again, we've talked about the different smoothing ratios you can use depending on what level of the microscope you're zooming in on. But it should give you a fairly robust toolkit to start looking at depending on what your trading or investing style is. You can use these tools to identify those macro shifts, which really, if you want to capture the bulk of the move, that's really what you're looking for as an investor. So the key signals, the NVT is a fast and noisy, lower conviction, but you'll see it first. RVT is a slow and high conviction signal and tends to be a lot smoother, representing that stored value. The primary signals, which will be the most value to investors, are when you move into an uptrend, signaling a bear market. It's effectively reducing demand for transactions or an overvaluation of price relative to utility, common of bear markets. When you get that reversal to a downtrend, and again, the NVT is best for looking at these transitions of trend, you start to move into that accumulation phase where the smart money is moving more coins. There's an undervaluation of the price. It's potentially heavily oversold, and it really represents that point of maximum opportunity for accumulation. And then the RVT, when it breaks below 10, which historically has occurred with the NVT, what we're seeing at the moment is that divergence because the RVT is starting to break below 10 whilst the NVT is somewhat lagging behind. And that's really indicative of a sustainable bull market. And there's a high level demand for transaction and block space, enough to support the ongoing price appreciation. So if we do see a horizontal move through this cycle, and I think this particular Bitcoin cycle will be very important because it's a point of maturation. We're seeing the network and the market infrastructure evolve at a fairly breakneck pace. So I think the way that this cycle behaves will really define the direction of a lot of these on-chain metrics. So I'll certainly be watching and talking about these with great detail. So a few resources and people who've written great pieces and things on the NVT ratio. I don't think anybody that I've seen has talked about the RVT ratio. I find it to be one of the highest conviction signals that I've used. And particularly when you look at when a good entry point is for a sustainable bull market, and when you can start to play with a little bit more confidence, to me it's a huge value add to your trading arsenal. So that's it. Now we can all throw tomatoes and have a discussion. If you've got any questions, and I haven't been watching the chat room, so if you want to get any questions in here now, I'm happy to keep plugging along and talk through some of these concepts if you've got thoughts. And yeah, so for the most part, the majority of my data comes out from Coinmetrics. They do a great job. Their community resource is invaluable. It's very valuable to just get a high level view. They've got an initial charting package. They've also got a really good API that you can start pulling things into Python or whatever your programming language of choice is. So there's a question here: thoughts about Lightning Network and Liquid? There's no question that the more Lightning Network gets adopted, or Liquid, or to be honest, whatever other level 2 or level 3 systems start coming out on Bitcoin, they will affect the NVT ratio and the RVT, simply because you're taking exchange volume off the base layer. I don't think that these ratios are just going to go to zero and be worthless, because you still have to, for Lightning, for example, there is still an on-chain settlement transaction in and out. So what we're going to see here, and yes, we may be able to start tracking data. I'm not aware of any at the moment for tracking data on Lightning Network, but we could start to see this develop. I wouldn't be surprised if we start to see these things develop. A lot of smart people looking at this problem. But if we think about this thing, let's assume that Bitcoin does in fact achieve some significant layer of level of adoption. You're still going to see a lot of demand for opening and closing of transactions. And that's why I'm saying that these fractals may change, but the concepts will still remain. So we're still going to be able to see a lot of these fractals play out in time. They may just evolve in the shape and the order of magnitude that they appear in. So I think as the market matures, we're going to see these shifts in what these ratios look like, but you can still interpret them as the ratio of utility to value. So that's the core takeaway here. It's utility versus value. In terms of the current market, so that's what I was talking about before with the RVTS. It's probably the first signal that we've seen where it's broken below that level of 10. To me, look, I think that based on current price action and even just the macroeconomic cycle, it's a lot more likely that we're in a bull market, and really that break above the realized price. Let me take it back a few and see if we can. Here it is. The most significant, so for spotting the start of a bullish trend or the end of the accumulation period, this is really your entry point. That point where it breaks above the realized price, and in fact this whole zone under here where you're in the accumulation phase is really undeniably the top spot for that. So that's really what you want to be looking for in terms of when you're the end of your bear market is really when it breaks up above that realized price. To me, that's the most significant buy signal for Bitcoin. Looks good. So, in case there's any other questions, feel free to stick any in the comments below. I'm happy to come back through and answer any of these as we go. But I hope you all got something out of this. Hope you got some value in understanding what this all means. I hope you can add it to your trading arsenal, and keep an eye out and keep watch for more of these modules. As I said, this is the third of the series, and I've got a whole lot more lined up. And to be honest, people are creating on-chain metrics of great value faster than I can study them. So there's no shortage of good information coming in. So stay tuned. Aside from that, thank you.
Real, like, honest to goodness, like, data and knowledge that Checkmate just presented. That's what we do. That's what Ready Set Crypto is all about. So head on over to readysetcrypto.com/NVT. I just set up a little short redirection for you guys, and we're starting to roll out our annual plans, so you can get a nice discount on doing 3 or 6 or 12 months. But yeah, thank you so much for hanging out with us, guys. Hope you learned something. Hope this is somewhat insightful. And yeah, looking forward to the future of this market and what Bitcoin does. And it's just a really exciting time. So thanks, Checkmate. Take care, guys.
Thanks, guys. Cheers. And just to answer that last question there, yes, the metric on mining, that is my next port of call, looking at difficulty adjustment and proof of work as an initial value or a key value metric for Bitcoin. So stay tuned. Thanks, guys. All the best.
Cheers, guys.